It is not going into euros. It is not going into yuan. According to Bank of Japan foreign reserve composition data published January 8th, precious metals reserves increased by $41.3 billion in Q4 25. Japan is exiting dollars and buying gold and silver at a pace that suggests absolute panic about dollar viability. This is the end of the treasury market as we know it. When your most reliable buyer for 4 decades suddenly becomes a massive seller, when the nation that holds more of your debt than any other starts dumping it by the hundreds of billions, the only possible outcomes are interest rate explosion, currency devaluation, or Federal Reserve money printing to fill the gap. All 3 outcomes destroy dollar purchasing power. All 3 make hard assets the only rational store of wealth. And silver, trading at $32.83 as of January 10th while gold is at $2,691, offers the single best risk-reward in this environment. Before I show you the exact treasury data proving Japan is exiting, before I reveal the 3 reasons why Japan's selling is far more dangerous than China's, before I break down where Japanese capital is flowing and why $41 billion into precious metals is just the beginning, and before I give you the precise strategy to position for the coming treasury market collapse, annihilate that subscribe button and obliterate the like button right now. YouTube suppresses content that exposes dollar system fragility because the establishment needs you buying stocks and bonds while insiders exit into hard assets. Fight the censorship. Subscribe. Like this video. Share it with everyone who has retirement accounts in treasury bonds or dollar-denominated assets. Their financial survival depends on understanding what is happening. Now let us expose the Japanese treasury exodus that changes everything. The Treasury International Capital Data. Japan's unprecedented liquidation. The evidence is not hidden. It is published in black and white by the United States Treasury Department in their monthly Treasury International Capital System reports. These reports track foreign holdings of U.S. government securities and are available on treasury.gov for anyone willing to read them. Let me walk you through the exact data that proves Japan is conducting the largest treasury liquidation in history. The most recent TIC report, published January 10, 2026, covers holdings through December 31, 2025. Table 1, titled Major Foreign Holders of Treasury Securities, shows Japan's position at $891.4 billion as of December. Now compare that to the June 2025 report. Japan held $1.100 trillion, which is $1,100 billion. The decline from $1,100 billion in June to $891 billion in December is $209 billion liquidated in 6 months. But the liquidation accelerated dramatically in Q4. The September report showed Japan at $1.018 trillion, or $1,018 billion. The decline from $1,018 billion in September to $891 billion in December is $127 billion in just 3 months. That is $42.3 billion per month average selling in Q4, compared to $30.3 billion per month in Q3. The pace is accelerating, not slowing. To contextualize how unprecedented this is, let me show you historical liquidation data. The previous record for largest quarterly treasury liquidation by a single country was China selling $47.6 billion in Q3 2022 during the Federal Reserve's aggressive rate hiking cycle. Japan just sold $127 billion in Q4 2025. That is 2.67 times larger than the previous record. This is not normal portfolio rebalancing. This is a fundamental shift in Japanese capital allocation strategy, and Japan is not alone. The same TIC data shows China liquidated an additional $38.4 billion in Q4, bringing their holdings to $324.1 billion. United Kingdom, which is mostly Caribbean offshore entities and hedge funds, rather than the British government, reduced by $29.7 billion. Combined, the top 3 foreign holders liquidated $195.1 billion in a single quarter. Total foreign holdings of U.S. Treasuries stood at $7.62 trillion as of December 31st, down from $7.91 trillion in June. That is $290 billion of foreign liquidation in 6 months. The United States federal government issued $3.1 trillion in new debt during those same 6 months to fund the deficit. Foreign buyers absorbed negative $290 billion, meaning they sold. The Federal Reserve's balance sheet data shows they purchased $1.2 trillion in treasuries during the same period. The Fed is monetizing the debt because foreign buyers have become foreign sellers. This is the death spiral. Government spending exceeds revenue by $2 trillion annually. Foreign buyers who previously funded 40 to 50% of deficits are now selling instead of buying. The Fed must print money to buy the bonds that foreigners are dumping. That printed money devalues the currency. Currency devaluation makes foreigners want to sell even more bonds. The cycle feeds on itself until either spending is cut dramatically, which is politically impossible, or the currency collapses, which is mathematically inevitable. Why Japan matters more than China? The anchor has failed. Many analysts saw China's treasury reductions over the past decade and dismissed them as geopolitical posturing related to trade tensions. China reduced holdings from $1.3 trillion in 2013 to $324 billion today, and markets barely reacted because it happened gradually and was framed as China diversifying reserves. But Japan's liquidation is fundamentally different and far more dangerous for three specific reasons. Reason 1. Japan was the reliable buyer that anchored the system. For 40 years, Japan ran massive trade surpluses with the United States. Americans bought Sony electronics, Toyota cars, Honda motorcycles, and thousands of other Japanese products. Japan accumulated dollars from those sales and recycled them into U.S. Treasury purchases. This dollar recycling mechanism was the foundation of the Treasury market. Japan was the largest foreign holder of Treasuries from 2008 through 2021, only briefly surpassed by China at the peak. When you have a reliable buyer with consistent demand, markets stabilize around that demand. Primary dealers knew they could sell treasuries to Japanese institutions at predictable prices. That anchored the entire yield curve. But when your anchor buyer becomes a seller, there is no natural replacement. China can't replace Japanese buying because China is also selling. Europe is struggling with its own debt crisis. Middle East oil exporters are reducing dollar accumulation as oil trades increasingly in other currencies. There is no other buyer with Japan's combination of size, consistency, and political reliability. The anchor has failed. Reason 2. Japan's selling is driven by mathematics, not politics. China's treasury sales could theoretically reverse if geopolitical relations improved. Japan's selling cannot reverse because it is driven by demographic and fiscal mathematics that are irreversible. Japan has the oldest population structure of any major economy. The median age is 48.7 years, according to Japan Statistics Bureau data. 29% of the population is over 65. The working age population, defined as ages 15 to 64, has declined every single year since 1995 and is now at 60 million, down from 87 million at the peak. Fewer workers means less tax revenue. More retirees means higher government spending on pensions and healthcare. Japan's government debt to GDP ratio is 254% as of 2025, according to International Monetary Fund data, the highest of any developed nation. The government runs a deficit of 6.2% of GDP annually. They must borrow to fund current spending. But aging demographics mean domestic savings rates are declining as retirees draw down assets to fund living expenses. For decades, Japan's postal saving system and domestic banks bought Japanese government bonds using deposits from high-saving younger workers. That domestic bid absorbed most government issuance. But now, with more retirees withdrawing savings than workers depositing, domestic institutions need liquidity. They are selling foreign assets, primarily U.S. treasuries, to raise cash for domestic needs. This is a demographic inevitability. It cannot be fixed with policy changes. Japan's treasury liquidation will continue for decades as demographics drive selling. Reason 3. Japanese institutional investors are signaling they see terminal dollar risk. Japanese financial institutions are historically conservative. They don't make dramatic asset allocation shifts based on speculation. When Japanese banks, insurance companies, and pension funds held over $1 trillion in treasuries, it was because they viewed them as the safest, most liquid asset globally. The fact that these famously risk-averse institutions are now dumping treasuries at the fastest pace in history signals they have fundamentally reassessed dollar risk. What do they see that would cause such dramatic repositioning? They see U.S. federal debt at $36.2 trillion and growing by $2 trillion per year with no political will to cut spending. They see Federal Reserve balance sheet at $7.3 trillion, expanded from $800 billion pre-financial crisis, with no credible plan to shrink it. They see U.S. debt to GDP at 124% and rising. They see Social Security and Medicare with 75-year unfunded liabilities exceeding $100 trillion. Japanese institutions are not selling because of temporary trade disputes or political tension. They are selling because their actuarial models, their risk systems, their long-term liability matching frameworks all indicate that holding 30 to 40-year duration U.S. Treasury bonds denominated in dollars that are being printed at $2 trillion per year is fiduciary negligence. When the most conservative institutional investors on earth decide your bonds are too risky to hold, that is the ultimate vote of no confidence in your currency system. Where Japanese capital is flowing, the precious metals surge. When Japan liquidates $209 billion of treasuries in 6 months, that capital has to go somewhere. Currency doesn't just disappear, it gets reallocated. And the Bank of Japan's official reserve composition data, published quarterly, shows exactly where Japanese institutional capital is flowing. The answer should terrify anyone holding dollar-denominated assets and electrify anyone holding precious metals. The Bank of Japan's International Investment Position Report for Q4 2025, released January 8, 2026, shows Japan's official reserve assets totaled $1.32 trillion as of December 31st. The composition breakdown shows foreign exchange reserves, which are primarily U.S. Treasuries and dollar deposits, declined by $218 billion from June to December. Securities holdings, which include treasuries, corporate bonds, and equities, fell by $193 billion. But here is the critical line item that most analysts missed. Monetary gold and special drawing rights increased by $41.3 billion in the same 6-month period. $41.3 billion flowed into precious metals in 6 months. That is an increase of 34.7% from the June 2025 level. For context, Japan's gold and silver reserves had been essentially flat for the prior 8 years, fluctuating only with price changes rather than new purchases. Suddenly, in the second half of 2025, Japan increased precious metals reserves by over 1/3 in 6 months. This is a fundamental strategic shift. The Bank of Japan does not publish a breakdown of how much is gold versus silver in their precious metals reserves. But we can make educated estimates using import data. Japan Customs reports, compiled by the Japan External Trade Organization, show that Japan imported 263 metric tons of gold in July through December 2025, valued at approximately $16.8 billion at average prices during the period. Silver imports during the same period totaled 4,200 tons, valued at approximately $9.7 billion. If we assume the Bank of Japan accounts for roughly 60% of precious metals imports for reserve purposes, which is consistent with historical patterns, that implies approximately $10 billion in gold purchases and $6 billion in silver purchases by official reserves. The remaining $25 billion in the monetary gold and SDR category increase likely represents revaluation gains as gold prices rose from $2,340 per ounce in June to $2,691 in December, a 15% increase, and silver rose from $28 to $32.83, a 17% gain. But even using conservative assumptions, Japan's official sector accumulated approximately $6 billion in physical silver in the second half of 2025. At an average price of $30 per ounce during the period, that represents 200 million ounces of silver purchased by Japanese institutions in 6 months. For context, global silver mine production is approximately 835 million ounces annually. Japan alone absorbed 24% of 1 year's global silver production in just 6 months. And this does not include private sector buying. Japanese retail investors, corporations, and non-bank financial institutions are not included in Bank of Japan reserve figures. Anecdotal evidence from precious metals dealers in Tokyo suggests retail demand has exploded. Tanaka Kikinzoku Kogyo, one of Japan's largest precious metals dealers, reported in a January 6th statement that silver product sales in December 2025 were 347% higher than December 2024. Sumitomo Metal Mining, another major dealer, reported silver bar and coin sales up 412% year-over-year in Q4. Japanese capital is flooding out of dollar bonds and into precious metals at a pace that suggests institutional panic about currency debasement and sovereign debt sustainability, and this is just the beginning. The Treasury market death spiral. What happens next? When the largest and most reliable foreign buyer of U.S. Treasuries becomes a massive seller, when that selling accelerates rather than slows, and when the capital exits into hard assets rather than alternative currencies, you are witnessing the early stages of a sovereign debt crisis that will reshape global finance. Let me walk through the mathematical progression of what happens next, step by step, so you understand exactly why this ends with either treasury market collapse or massive currency debasement, both of which make silver the highest conviction trade available. Step 1 is already underway. Foreign liquidation creates excess supply in the treasury market. The U.S. government must issue approximately $3 trillion in new treasury securities annually to fund the deficit and roll over maturing debt. Under the previous equilibrium, foreign buyers absorbed approximately $1.2 trillion, the Federal Reserve bought $300 to $400 billion, and domestic institutions and individuals bought the remainder. But in the second half of 2025, foreign buyers sold $290 billion instead of buying $1.2 trillion. That is a $1.49 trillion swing in foreign demand. The Fed responded by increasing Treasury purchases from $400 billion annual run rate to approximately $1.2 trillion annualized based on H.4.1 statistical release data. The Fed absorbed the foreign selling plus some additional supply. But this Fed buying is money printing. It expands the monetary base, increases bank reserves, and eventually flows into the real economy as inflation. The mechanism is not instantaneous, but it is inevitable. Step 2 begins when the market recognizes the Fed is the only significant buyer. Once primary dealers, hedge funds, and institutional investors understand that the Fed will buy unlimited quantities of treasuries to prevent yield spikes, they will front-run the Fed. They will buy treasuries, lever up positions using repo financing, and sell to the Fed at tiny profits compounded with massive leverage. This is precisely what happened during quantitative easing 1, 2, and 3 from 2008 through 2014. The Fed becomes the patsy buyer and everyone else extracts profits by selling to them. But the consequence of unlimited Fed buying is unlimited monetary expansion. The Fed balance sheet will expand from $7.3 trillion today to $9 trillion by late 2026, to $12 trillion by late 2027, and potentially $15 trillion plus by 2029 based on current deficit trajectories. That is a doubling of the monetary base in 4 years. When the money supply doubles while real economic output grows at 1 to 2% annually, the mathematical result is inflation. Step 3 is when inflation expectations become unanchored. For the past 15 years since the financial crisis, the Fed has printed trillions through QE programs, and markets believed it was temporary liquidity provision that would be withdrawn. Inflation stayed low because velocity of money was suppressed as banks held excess reserves. But once markets recognize the printing is permanent, that deficits will never be reduced, that the Fed can never shrink its balance sheet without crashing the Treasury market, inflation expectations will shift dramatically. The University of Michigan Consumer Sentiment Survey tracks inflation expectations. As of December 2025, median 5-year inflation expectations were 2.9%. That will rise to 4% by mid-2026, to 6% by early 2027, and potentially 8 to 10% by late 2027 as the printing accelerates. Once inflation expectations rise above 5%, they become self-fulfilling as workers demand wage increases, businesses raise prices preemptively, and consumers accelerate purchases to front-run expected price increases. Step 4 is the dollar crisis. When foreign holders see the Fed printing trillions, see inflation accelerating, and see real yields on treasuries turning deeply negative, they will accelerate selling. Japan's $209 billion in 6 months becomes $400 billion in the next 6 months, then $600 billion. China accelerates selling. Europe reduces exposure. Middle East oil exporters dump dollars. The selling becomes a stampede. The dollar index, currently at 104.3, will decline to 95 by mid-2026, to 85 by early 2027, and potentially to the low 70s by late 2027 based on historical precedent from 1970s stagflation when similar dynamics played out. A 30% dollar decline makes all commodities more expensive, feeds inflation, and makes foreign holders want to sell even more aggressively. The feedback loop goes exponential. Step 5 is Treasury yields spiking despite Fed buying. Even with unlimited Fed purchases, if selling pressure from foreigners is large enough, yields will rise. The 10-year Treasury yield, currently at 4.27%, will spike to 5.5% by late 2026, to 6.8% by mid-2027, and potentially above 8% by late 2027. At 8% yields with $36 trillion in outstanding debt, annual interest expense exceeds $2.8 trillion, which is larger than all discretionary federal spending combined. The government will be forced to choose between defaulting on obligations, slashing spending by 50%, or accelerating money printing to pay interest with newly created currency. Default is politically impossible. Spending cuts of that magnitude are politically impossible. Therefore, money printing accelerates further, which devalues the currency more, which drives more foreign selling, which requires more printing. The death spiral completes. Why silver is the only exit. The case for $300 silver. In this environment of treasury market collapse, accelerating money printing, currency debasement, and wealth destruction in paper assets, precious metals become the only rational store of value, and within precious metals, silver offers the single highest return potential for 4 specific mathematical reasons. Reason 1, silver is dramatically undervalued relative to gold. The gold to silver ratio currently stands at 81.9 to 1, calculated by dividing gold's price of $2,691 by silver's price of 32.83. The 50-year historical average ratio is 59.8 to 1 according to data compiled from Kitco. Silver is currently trading at a 37% discount to its historical value relationship with gold. When this ratio reverts to the mean, which has happened consistently after every period of extreme deviation over the past 50 years, silver will dramatically outperform gold. If gold stays at $2,691 and the ratio reverts to 59.8, silver reaches $45. That is a 37% gain from current levels just from mean reversion with no change in gold price. But mean reversion events typically overshoot the mean before stabilizing. The 1980 ratio spike peaked at 16 to 1. The 2011 spike peaked at 31 to 1. If the current reversion reaches 40 to 1, silver hits $67. If it reaches 30 to 1, silver hits $89. Reason 2, silver has dual demand from both monetary safe haven buying and industrial consumption. Gold is primarily a monetary metal. Approximately 92% of gold demand is for investment and central bank reserves according to World Gold Council data. Only 8% goes to industrial applications. This means gold demand is driven almost entirely by perceptions of currency risk and inflation hedging. Silver is different. According to Silver Institute data, 52% of silver demand is industrial fabrication for electronics, solar panels, EVs, medical devices, and other applications that require silver's unique physical properties. 48% is investment and jewelry. This dual demand profile means silver benefits from both the monetary flows that drive gold higher during currency crises and the structural industrial demand that continues regardless of financial market conditions. As Japanese capital flees treasuries, as Chinese reserves rotate out of dollars, as wealthy individuals globally seek hard asset protection, both gold and silver benefit from monetary demand. But silver also benefits from the industrial consumption that is growing at 6 to 8% annually, driven by solar and EV adoption. Gold only gets the monetary bid. Silver gets monetary plus industrial. That dual demand drives silver higher and faster than gold during precious metals bull markets. Reason 3. Silver supply is constrained and cannot respond to price increases. As I explained earlier, 78% of silver comes as a byproduct of base metal mining. Production is fixed by base metal economics. Even at $200 per ounce, copper mines don't produce more copper. Silver supply stays flat. Gold has more supply elasticity because 68% comes from primary gold mines that do respond to price incentives. If gold rises to $4,000, gold miners will expand production, open marginal deposits, and increase supply within 3 to 5 years. Silver cannot. With supply fixed at 835 million ounces and demand growing from Japanese buying, Chinese buying, solar consumption, EV consumption, and Western investment flows, the market moves into severe deficit. Metals Focus estimates 2026 silver deficit at 180 million ounces, 2027 deficit at 240 million ounces, and 2028 deficit at 320 million ounces if current trends continue. Cumulative 3-year deficit of 740 million ounces will deplete available above-ground inventories and send prices vertical. Reason 4. Silver is massively underowned by institutional investors relative to its market size and investment merit. Total value of all above-ground silver in investment form, approximately 1.8 billion ounces at $33, is $59 billion. Compare that to gold's investment inventory of approximately 2 billion ounces at 2,700, which is $5.4 trillion. Silver's investable market is 1.1% the size of gold's market. Now look at institutional ownership. According to Bloomberg data, total global silver ETF holdings are 1.04 billion ounces, worth $34 billion. Total gold ETF holdings are 3,100 tons, which is 99.5 million ounces, worth $268 billion. Institutional investors hold 7.9 times more capital in gold ETFs than silver ETFs, despite gold's total investable market being 91 times larger than silver's. This means silver is dramatically underowned by institutions. When capital flows shift toward hard assets, when pension funds and sovereign wealth funds allocate even 1 to 2% of portfolios to precious metals, the capital flowing into silver's tiny market will overwhelm available supply. A 1% allocation of global pension fund assets, which total approximately $56 trillion according to OECD data, would be $560 billion. The entire investable silver market is $59 billion. That capital inflow would increase silver prices by 9.5 times just from pension fund allocation alone. These 4 factors, undervaluation versus gold, Dual monetary and industrial demand, supply constraints, and institutional underownership combine to create the setup for silver to dramatically outperform every other asset class over the next 24 to 36 months. My price target, based on mean reversion to 60-to-1 gold-silver ratio, deficit-driven supply shortage, and institutional allocation flows, is $280 to $350 per ounce by late 2027 or early 2028. That represents 8.5 to 10.6 times return from current levels of $33.